Good day, guys. How are we all doing? I hope we are all good. I hope we are all blessed. All right, we're going to resume. Last time we finished on page 147. We are going to resume from page 148. So, without wasting much time, I'm just going to get into it. How to trade the false breakout, how to trade the false breakout of the inside bar candlestick pattern. Have you ever placed an order with confidence thinking that the market is going to go up? But price hits your stop loss before it starts turning out to your predicted direction. I have been a victim of stop hunting and I was very disappointed, but that happens several times in the markets. Banks and financial institutions know how we trade in the market. They know how we think and where we put our stop losses and profit targets. This is the reason why they could easily take money from us. One of the most famous strategies that big players use to make money from novice traders is called stop loss hunting strategy. This strategy consists of driving prices to a certain level where there are massive stop loss orders, and the purpose is to create liquidity because without liquidity, the market will not move. Once stop losses are hunt, the market goes strongly in the predicted direction. The interaction between big participants and novice traders creates repetitive patterns in the markets. One of the most important candlestick pattern that illustrates how big financial institutions manipulate the market is the inside bar false breakout pattern. Your understanding of this repetitive setup and your ability to detect it on your charts will help you better exploit it to make money instead of being a victim of the market makers and bank manipulations. This price action signal is formed when price breaks out from the inside bar pattern and then quickly reverses to close within the range of the mother bar. See the illustration below. All right, so let's see the illustration. All right, so I think this is pretty simple. You get your mother bar, just like the author showed us there, right? That's shaded. And then you get your inside bar within the mother bar, right? And the premise of this inside bar, like we read in the past few pages, is we trade the breakouts. When price comes above, we're going to look for longs, or if it's coming below, depending with where the market is going. So a false breakout is when price like spikes above the mother bar level, triggering breakout traders, and then coming back and closing within the mother bar range. So that's a faker. So let's see what the author says about it. So this is just an example which they're showing here. That's the fake out there. So let's see what the author is saying. Oh, here's another example: bullish inside bar false breakout. So this is a bullish example where price breaks to the bottom but then comes back inside, allowing price to potentially push all the way up. So let's see what it says. As you can see, there are two types of this price action pattern. A bullish inside bar false breakout that forms when the market is trending down, and it is also considered as a bullish reversal signal when it is formed near a key support or resistance level. A bearish inside bar false breakout that occurs in a bullish trend, and it is seen as a bearish reversal pattern when it is found near an important level in the market. This setup can be considered as a continuation pattern if it is traded with the trend. Examples: inside bar falls breakouts. Examples. In my own experience, the most important levels that traders should look for to trade this signal are the following: support and resistance level, supply and demand areas, Fibonacci retracement levels, particularly the 50 and the 61 retracement levels, the 21 moving averages and the trend lines in trading markets, horizontal levels in range-bound markets. Here's an example of how to trade the inside bar false breakout in a trading market. So before we go down, I just want to explain these notes stated here. Support and resistance levels, supply and demand. We've gone through this in greater detail. The fib retracement, we've gone through this on the 21 moving average. So, like I said, if you notice on my charts, I use the BTMM moving averages. So that's 13, the 50, the 200, and the 800. All of these are exponential moving averages and they're set to close. The author, however, uses the 21 moving average. So if you want to test it out, you are free to test it out. If you're using the ones I use, you're free. If you use naked charts, that's still perfect because you can still use all these like your support and resistance, supply and demand. You can use the fib and you can use horizontal levels in the range bound. So don't stress much about the moving averages. That's the point I wanted to highlight there. So here's an example for how to trade the inside bar false breakout in a trending market. Okay, so here's the first thing. Price is pushing down, right? We have to agree that price is pushing down, but we hit a zone here, which is a support zone. That's the first thing. Once a support zone is broken, it becomes a resistance if price retests, right? So support becomes a resistance. You can see the author also highlighted it there. Then on that same area, we've got a mother bar. We've got an inside bar. So remember, on an inside bar, it could be a reversal, it could be a continuation. If it was a reversal, then this candle inside would have closed above it, would have taken longs. But if you notice, they came and they spiked on to a resistance level and the price continued to push down, making this a fake out. So they faked out of this, the high of this mother bar, and they came and they broke out on the bottom side, which made this a sell entry. So let's see what the author says about this particular setup. As you can see in the chart above, the market was trending down. That indicates that sellers are in control of the market. So if you decide to sell the market near the resistance level, all probabilities will be in your favor. But the question is when to enter the market and where to put my stop loss. If you enter the market aggressively before the breakout of the mother candle and you put your stop loss above it, and the market will take your stop loss and go in the predicted direction. Excuse me. Let me see if I read this correct. If you enter the market aggressively before the breakout of the mother candle and you put your stop loss above it, the market will take your stop loss and go in the predicted direction. Okay, that's true. So here we're definitely anticipating sells, right? But the safer sell, I always say safe sells are always after a candlestick has closed, whether at a point of interest or at your preferred zone. That's the safest entry. An aggressive entry, however, like the author is saying, is when you know that you're leaning on the what? On the downside, and after you see this inside bar, you decide to sell, right? And you put your stop loss above here, price will definitely take you out. So let's see what the author is saying in terms of entry. So there is aggressive entries, there is also conservative entries, right? So as illustrated above, big players hunt novice traders stops before pushing the markets to go down. If your stop loss was near the resistance level, you would be out as well. And if you don't understand the reason why, it is simply because you're a victim of big players hunting stop strategy. Of course, there's many arguments here, but for the sake of this book, we're just going to go with what's written by the author and to just support it with charts and not to go into other arguments based on like liquidity and the reasons why stop has happened. All right. If you're familiar with trading the inside bar false breakout, you will understand what happened in the market and you simply take advantage of this manipulation instead of being trapped by the market. See the example below. All right, this is CJ. This is the 4-hour chart. Trading inside bar false breakout. All right, stop loss entry. Okay, let's see what the author is saying here. As it is illustrated above, the inside bar false breakout gave us a good selling opportunity. If you're able to identify this setup and you understand the psychology behind it, there should be no reason not to get into this position. Trading inside bar false breakouts with fib retracements. So I'm not sure if we should jump into the charts now Let's actually do that. So okay, I hope you guys can see my screen. I don't want to be this video to be like the last time where you guys couldn't hear me. So we're going to use, let's use the pair which the author is using, CJ, CJ. That's a nice sell there on Friday. All right, let's go to the 4 hour. I'm going to try to look for an area where we are trending clearly so that I can be able to explain this particular setup. So this is an uptrend, but its range is maybe here. Let's see. So I'm going to zoom in a bit, try to look for inside bars. Let's see. Okay, so after, okay, where do we say we are pushing up here? From which point do we say we're pushing up? So let's see, all the way down. If you look to the bottom left, we got this spike, price pushes up. So after we break this high, that's when we start anticipating buys. We've got a demand level here. Remember, we did this session on the last video we did. So nice acceleration to the upside in demand level here. Price comes back and tap. So we agree roundabout from here, we are now trending up, right? We are in an uptrend. So let's see if from that area, if we can find our inside bars. So we've got this level here. We've got this level here. You might be wondering where these levels coming from. So is prices coming, remember, from the previous few pages we read. If you're stalking price like candle for candle or zone to zone, after you figure out that you are bullish or after a break of structure, you want to pinpoint the highs to see whether you're still continuing up or you're now in a ranging market. So here we've got a demand zone. Here we've got two equal highs. That's where this horizontal line is coming from. Here we've got our demand zone. That's where this line is coming from. So once we have those zones, here we're trading within a range until we break out, right? Here we broke out, came back below into this level here. There's a lot of things to explain here. This is such a bad example. But anyways, let's see if we're going to look at an inside bar at some point. Okay, we've got an order block here. Yeah, I'm just marking areas where price sort of respected, just to get a view of what's going on, right? Okay, let's see. So after coming back above this zone, price is pushing. I'm now starting or looking for an inside bar, and I'm potentially looking for one with a fake out. It's going to be really hard to spot. Let's see. Moving here, we push up. This here is an inside bar, but there is no, I don't see a fake out. That's why I cannot talk much into this. So we've got a mother bar here. Remember, we right on a zone, we're bouncing on a zone. So we've got an inside bar working is a continuation or a reversal to this push down. So here they're hitting what is support zone and they push up. So for a normal inside bar, that would be a clean pattern. But the one with a fake out might be hard to get. Let's see. Okay, from this high here, just following levels here to see. Okay. Nah. Okay, let me look at another pair. Maybe let me look at the ones on my watch list. Because I need to look for one with with a clean fake out. Let's see, this was my setup on Friday on gold. I think it was actually from Thursday. They retraced and they started pushing down on Friday Asian. So there was a sell, but they didn't follow through to the downside. All right, let's see. Can we get something? I think this might be hard to get. Okay, here we're pushing down. Do we have an inside bar? Okay, let me use the daily. Use the daily. Look for a trend. Okay, somewhere here. Let's see. So on this particular chart, I'm looking at this high. As soon as it was broken, I know that I'm now what? Now bullish. So I'm looking at a break, retest. Then we start looking for inside bars. So if we zoom in to where we've got okay, perfect. Thank God I found an example. Okay, so after this high was broken, right? That resistance area, it becomes support, right? Let's agree that it becomes support. We know that we're pushing down. So be in mind, price can still come into this zone here. That's one thing you should know. It's not that price will just respond here and push up. Sometimes price will come all the way back into this order block or even back here. That's one thing you should also know. But if something you've read, like for example, this inside bar we're about to explain, if something you've read happens while you're looking at the charts, all you have to do is execute like what the author says. So if you zoom in here, you see that we've got a mother bar, right? And we've got an inside bar. Okay, this is our mother bar. Then we have that candle which is within the mother bar, so that's the inside bar. So is the price broke to the downside? So remember, at some point this candle was black. If your bearish candles are black, if they are red, at some point this candle was red as it was forming. It was red. The thing. Okay, at some point this candle was bearish coming down here. This was bearish showing sells, right? So if you sell here, this price will definitely come back in and take you out. But knowing that this is a support zone, we know that we're buying, right? So look at how this price or this next candle actually spikes above here. So we don't know whether this candle spiked above first and we got into the buy, or it spiked down first. But the main thing I want to explain is this spike below. So we know that we're buying. So if we had bought maybe at the close of this candle, anticipating price to go up, our stop loss would have been here. If it was at the close, then the stop loss was not hit. But if the entry was aggressive, like what the author said, we don't know the price range within this area. Let me see the date, if I can be able to pinpoint 23 November. Are we able to go to a smaller time frame? What's going to take us time? Okay, I don't know how best to explain. But if you know how a candlestick forms, right? Let me just touch into that a little bit. So a new candle, when a new candle forms, it starts here. This is the open price of the candle. If price starts by pushing up, then pushes down, it will leave the wick. Then this candlestick body will be bearish, right? Bearish, depending with where the candle goes. So if it continues, let's say it continued to push down, it will be solid until it comes back up and then closes here, right? Then it will close bearish if this was the open price. If the open price is higher than the close price, that candle is bearish, or it's red, or it's black in this example, right? So this is the high price of the candle, this is the low price. So in this particular on this particular candle, this candle probably started here and it pushed down, because now the close is above, that's why it's green, right? So that's what I want you to understand. So this example, again, it might not be the best, but what I just wanted to highlight is this wick below, depending with where you enter your trade. So if you enter it at the close of the inside bar, if your entry is aggressive, as it comes down, remember your stop loss is below here. So if it starts by coming down, it will definitely take you out before it comes up and closes. You get it? I think that's what the author is trying to elaborate there. Or maybe my example is a bit biased, but That's how price moves, right? So if price comes below the mother candle, that's where your stop loss is. And we are considering that you are an aggressive trader. You've entered right at the close of the inside bar, anticipating that this is support. And for sure, this is what? This is support. This is your support zone because this level was broken here. So it's now support. So if you saw this was support, inside bar, you already have that buying bias and you take a buy before this candle closes. This price will take you out, but still continue to push in the direction. All right. So my explanation, maybe it had so many words there. Just be with me, but I think you understand what the author is trying to say. So the price will what? Price will definitely take you out before it starts to move. So this is one example which I found, which is a bit clear of a fake out, but it's only qualifies as a good example if you're an aggressive trader. A conservative trader will sometimes wait for price to actually break above here and close. Most likely enter here and allow the stop loss to still go below the motherboard. But this price action was already what? In motion. That's also what you should understand. So don't expect perfection, if I may use that word. Don't expect too much perfection in terms of how price moves. That's why there is that manipulation which the author is talking about. It will always happen, and the dealer will always take people out. And the other reason I think why most people like to enter aggressively is because of this. I want you to notice this. Okay, we agree we're in an uptrend. Price is pushing up. We've got a zone here. This is an inside bar, right? But if you want to wait for price to close above the mother bar for you to enter the buy, you're going to wait for 1, 2, 3, 4, 5 days until you enter your trade. You enter your trade here, you're buying, right? Your stop loss is below the motherboard. It's here, the mother candle. Am I saying motherboard? Below the mother bar or the mother candle, right? It's going to take 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 days until you get back to break even, and more days until you get into profit. So that's why usually most people, as soon as you the inside bar closes and you are sure of your direction and your market is trending, people will enter a buy here, then the stop loss goes below the motherboard. This already allows you to get a 1 to 1, 1 to 2, 1 to 3, 1 to 4, 1 to 5. By the time this price gets to the top of the mother candle, you already close your trade or you've already made your profit. So I think you should actually know that these are some of the variations which happen in the market. Sometimes you might have to wait longer if you are very conservative. If you wait for safe entries, you always have to wait longer because you need to be more patient. But if you're an aggressive trader, as soon as you see an inside bar, you will take your buy. But remember, price might take you out, like what the author is saying. Sometimes it will be perfect. You enter and your trade will just what? Will just play out. So these are two examples on a training market which show a false breakout here or a fake out which takes you out, and a perfect trade which actually moves in. But be in mind these variations to these entries or to the way these setups are actually executed. So I hope that example there was a bit clearer. Let's see if there's another inside bar. There's another one here, this one. So this is the mother candle or the mother bar. Again, same thing. This one is the perfect one with no fake out. So if you're an aggressive trader, you enter here knowing that price left you a what? A demand zone here. So this inside buy is happening at a demand zone. That's the first thing, which gives you high probability, and you know that you're trending up. So your chances of this price coming up to going down, the chances of the price going up are higher compared to going down. So you will take your buy soon as the inside bar closes. Map out 1 to 3 or 1 to 2, take your spoils. But if you're waiting for a safe entry or for price to break out of the mother bar, like we're explaining in the other lessons or in the other session, you'll find out that your buy will only come. It might come here, but remember this also closed below that zone. So the safe buy maybe would be here, your stop loss would be here. But trades like these will take time. You will be in this trade for the longest of time. As much as it plays out even 1:2 on a daily chart, it takes time for you to get there. It will take you You enter here, so that's 1, 2, 3, 4, 5, 6, 7, 8, 9 days of holding. You'll be paying swap. There's a fee which most brokers will charge you if you hold your trades overnight or over the weekend. That's swap. So sometimes again, you see this price came all the way back to your entry. You were halfway through the profit, and sometimes you might close thinking they want to come down, then they will still continue going up. So this is what I would say a disadvantage maybe of swing trading or holding your trades for a couple of days. It needs somebody who's extra patient. So swing traders who are actually patient and are used to this can trade this, it's fine. But if you're day trading, I would advise you look for these particular setups on the smaller time frames, maybe each one, so that you don't really have to hold for long. But after all has been said and done, you can see that these candles are there, the inside bars are there, the fake outs are there, the ones with no fake outs are there. So it's all about timing and screen time and following price on the particular assets you trade. Right. So without wasting much time, I'm going to jump back into the book. All right. So we here. All right. Trading inside bar, false breakouts with Fibonacci retracements. So again, don't beat yourself up if you feel like maybe these ones with fake outs are hard to notice. This book lists multiple strategies of attacking the market. So if the fake outs are hard to trade, then don't look for them when you're trading. Look for something which you're familiar with. I think that's one other point which I'll just stress out there. So let's continue. I don't really know if you're familiar with this technical trading tool. However, I'll try to show you how to use it in a simple and efficient way in combination with the inside bar false breakout. What you have to know is that in an uptrend or a downtrend, the market creates impulsive moves and pullbacks. What is an impulsive move? What is a pullback? An impulsive move is when price, let's say we're trending up, right? This is a trending market. Also take note, we use fibs in a trending market. We don't use fibs in a ranging market. So when the market is trending, the impulsive move is that big push. Then you get a retracement. You get a big push, a retracement, a big push. So when the dealer is saying the market will create impulsive move, this big move here, these are the impulsive moves, right? And these are the pullbacks. The pullbacks are also the retracements, just different terminology. If you're pushing down, these big pushes down, those are your impulsive moves. Then these are the pullbacks. Impulsive move, pullback, impulsive move, pullback. That's how a trending market moves. I think we've been explaining it as well in the past few sessions. So the fib retracement helps us highlight the most important pullback levels in the market. That's the main use of the fib, right? The best Fibonacci retracement levels that I personally use are the 51 and 60 levels. According to my experience, these levels are the most important areas that experienced trader watch for in their charts. I think if you check a few pages before this on either the previous video we spoke about the fib in greater detail. Our strategy is simple. We select the technical tool on our chart. If the market moves strongly, we wait for retracements. If the pullback reaches 50 or 61 level, we need just price action signal to confirm our entry. See the example below, right? Impulsive move, pullback. Impulsive move, pullback. Then here we've got sort of equal lows. Maybe price was trying to what? To reverse, because here there is no impulsive move. But for the purpose of the author's example, this is the impulsive move. This is also an impulsive move, right? So price retraces, right? So you want to mark your high and you want to mark your low. That's how you drag your fib. Then when price reaches 50 and 61, you want to see what type of candles is the price giving you. Are they giving you an inside bar? Are they giving you a bearish engulfing? Like all the candles we spoke about, are they giving you a pin bar? So I want you to notice that here we actually have a mother candle. We've got an inside bar. This false breakout is also a pin bar tapping into our zone. So now when you know your candles, it's easier to get into a trade, or it's easier to execute on a particular setup which you would have found on your chart. So inside bar false breakouts, they break out to the top, but we know that we're bearish, so we're not falling for this, right? We mark the high of the mother bar, we mark the low of the mother bar. If you were to sell just as the inside bar happens, remember stop loss will be here, so it will take you out. But if you're using fibs, you know that you're within the sweet spot area or the kill zone. Usually you hear me use the term kill zone. That's where we actually execute, right? So the fake out actually taps into our point of interest. Then the price from there just melts all the way down. So let's see what the author is saying here. By adding this technical trading tool to your strategy, you'll be able to identify potential trade setups in the market. If you analyze the chart above without using it, you will know the reason why the market dropped after the pullback, right? So if you're moving with us, if you've been reading this book from the first page, you understand the reasoning for this particular setup to form. Everything here is clear, right? So we're going to jump into the charts just now to look for a particular example. Again, we're going to use the naked chart just to make this more clear. Excuse me. So Fibonacci 2 can be used to trade the pin bar, the inside bar, and the engulfing bar setup as it was discussed in previous sections. This is what I just explained. The Fibonacci 2 can be used to trade the pin bar, the inside bar, and the engulfing bar, right, setup as it was discussed in previous sections. The trade above is very profitable because there are lots of factors of confluence that encourage us to place a sell order. The first reason is the trend, right? Before you take your trade, you want reasons to trade. I always mention have your reasons to trade. So the first reason is the trend, and it is obviously down. The second reason is the key Fibonacci ratios that represent a resistance level. And the third one is the inside bar false breakout, right? One signal is not quite enough to make good trading decision. You have to look for multiple triggers that support your analysis. This way you put the odds of success in your favor. Look at another potential trade below. Okay, so what do we have here? Price was coming down, price was coming down. I'm trying to wonder what made them feel that this is actually an uptrend. Because looking at it for now, I do not have any break structure. But anyways, let's see how the author explained this one. So price was coming down. Before we read what the author said, let's agree that this price is coming down. If this is a retracement, maybe should have been halfway. Maybe that's their reasoning. Okay, then they hit the zone, then they started pushing up. So personally, I would love to start looking for buys when I see this high get broken, right? When I see it get broken, then that's when I'll start maybe lining my fib maybe here. But let's see what the author is saying here, because this looks like it's a reversal. They're trading a reversal. My reasoning is, how did they figure out that this is the impulsive zone and this is the retracement? I'm sure you guys would have the same question as well. But anyways, let's see how the author explains this. So as you can see, the price moved higher, pulled back to reach our key ratios, and then continued higher. The formation of the inside bar false breakout in this area indicates that the pullback is finished and another strong move will take place. Okay. Honestly, here I do not have a reasoning, but for me, it looks like it's a reversal. So they just measured this move, I guess. So there's also a tool in trading called an average daily range. I'm sure that will help you guys. Depending if you use indicators, ADR, some call it's abbreviated as ADR or average daily range. So if you know your daily range, what time frame is this? If you know your daily range, it's sort of easier to know whether it's a retracement or it's a reversal, and this is actually the impulsive move pushing up. So on this chart, there is no time frame, so we're not sure what time frame this is. But let me also specify this. Let's say you're on an M15 chart. Let's say this is an M15 chart, right? Because people might say maybe I'm a day trader. in the setups being shown are higher time frames I cannot hold. Where will I trade if I don't want to hold? So let's say this was our Asian session, right? Price came down, gave us this lovely rejection, but also we need data to the left. If this was a zone, then this would qualify as an impulsive zone. Then we can run up our fib, wait for a retracement or a pullback, then look for a continuation back into the range to close the day here. So this is an example if this was an M15 chart. If this was an H4 chart or a 4-hour chart, this is week beginning, this is week closing. So we're saying this is information for the whole week. Again, price would come down as the week starts. Then we have that midweek reversal, right? So as long as you know what you are anticipating, it makes it easy to use the tools which you have. So if this was the midweek reversal here, then this would also qualify as an impulsive move. I think if you approach the charts that way, if you know what's going on, it's easier to use these tools. So I hope that explanation sort of clears things out there. So let's just explain this according to what the author said. So after running a fib from this low to this high, the 50 and 61 levels are here. So we're watching price as it is approaching that zone, right? Watching price. As soon as they get here, you see that you've got your mother bar and we've got an inside bar in here. An aggressive trader would want to buy soon as the inside bar closes. Then the author is saying, take note because there will be an inside bar with a false breakout. So they break out to the downside, making us want to sell, but we know that no, the impulsive or the directional bias is bullish. So we have to wait for the breakout to happen. Then after that, you can see we had a couple of pin bars there. And the fact that all this action is happening on our Q zone, which is the 50 or the 61.8% levels. If you see me post my charts, I tame this area Q zone, or you see me pushing P on my charts. If you are in any of my groups, you see pushing P. It's the same zone. It's this zone. ICT. I think this is the OTE area. Those who follow ICT, if I'm not mistaken, I stand to be corrected. Optimal trade entry, right? That's where your high probability of a trade playing out will be lying. So it's different terminologies, but explaining the same thing. So soon as we had that fake out, it's a pin bar, doji pin bar rejecting the zone, then we can buy stop loss below those candles. Then you map out 1:2, 1:3, the trade, the trade still played out. So as you can see, the price moved higher, pulled back to reach our key ratios, and then continued higher. The formation of the inside bar false breakout in this area indicates that the pullback is finished and another strong move will take place. Understanding the market structure is very important. That's what I was trying to highlight. Understanding the market structure is very important to know how to use this strategy in your advantage. If the market is trending, you can trade the inside bar false breakout as we discussed before. But if the market is ranging, you have to change your tactic. Please take note, guys. It's different weapons for different scenarios, right? See the illustration below. We've got a resistance level, right? We've looked to the left and we know we are in a resistance area. Prices come into that zone. What do we have? We've got an inside bar. We've got a mother bar here. Then we've got inside bars here. And we also have an inside bar within an inside bar. So we might even use this one as the mother candle. But again, you see there is that breakout. So you don't have to buy here. Why? Because the structure is showing that you are at a resistance area first. And because you've read this book, you anticipate, through reading, you now anticipate, okay, when I'm at a resistance, two things will happen. Either the resistance will be broken and it will become support, or the resistance will hold. If it holds, what candles show me that they are holding? Okay, let's see. I've got a mother bar, I've got an inside bar. I've just noticed there was a fake out, right? Which I read inside bar false breakout. Then price is definitely going to focus. They are rejecting a resistance level. If you understand liquidity, we've taken out liquidity here, and the price just melted all the way to the bottom side. Okay, so I hope that's clear. And again, guys, this will take time. If you notice when we go to the charts, it's not every day where you see the candles, but when you see them, you should execute. That's the whole point why we do this reading and back testing and forward testing. So in the chart above, the market is trading between horizontal support and resistance levels. As you see, if you had entered as soon as the market breaks out from the inside bar and the resistance level, you will be caught in a false breakout. The false breakout is formed because amateurs try to predict the breakout of the inside bar and the horizontal level early to pick the top, but the market faked them out and formed a bull trap. If you find this pattern in your chart and you understand that buyers were trapped by sellers, take this trade without hesitation because it is very profitable and it will offer you a good risk to reward. You place a selling order after the close of the break bar and you set your stop loss above it. Your profit target is the next support level. This strategy is not complicated, but it requires time and practice to master it, just like I mentioned. Bear in mind that a false breakout doesn't happen every time, and not all false breakouts are worth trading. This is all the points I was stressing out, and that's what the author is saying. The benefits of trading the false breakout of the inside bar candlestick pattern. If you master trading this pattern, this will allow you to stay away from trapped traders and enter the market when novice traders have to get out with a loss. This strategy is not a holy grail. You have to be prepared to accept some losing trades. But what is interesting about it is that the risk to reward of this signal has a great potential because when big participants surprises small amateurs and take their money, the market moves very strongly and if you can analyze correctly what happened, you enter in the right time making big profits. So imagine risking 50 points for 400 points. This is a 1:8 risk to reward ratio. Imagine risking 1% to make 8%. Those doing profits. You will notice there are people who sometimes pass a profit with one trade. You think maybe they're gambling. Sometimes a person is just tuned in to what price is doing, and you get a 1:8 setup and you pass your profit. This is exactly what they'll be following. So using this price action strategy will help you predict proper turning points in the market in advance and understand how banks and financial institutions trade the market. Trade examples. So after these examples, we're going to jump in the chart and we're going to conclude this session. So trade examples. In this section, we're going to show you different trades examples to help you understand how to trade the market using all strategies discussed in the previous sections. Okay, I think here they're doing a roundup. I think probably this book is about the end. So before we get into the trade example, guys, I think it's okay if we can quickly jump into the charts again. Gold 4 hour. Let's see. I'm just going to open anyway. Let's see what the price is showing us. Okay, we've got a nice trending market here. Do we agree that we've got a nice trending market here? But the only thing I'm not sure is if we're going to get our false breakout inside bar. But anyways, where do we say we are now trending up after a high has been broken, right? We're now creating higher highs, higher lows, higher highs, higher lows, higher highs. It's an uptrend. So soon as we figure out that we're trending up from this last low here to this highest low, we want to run a fib retracement. Okay, I'm not sure if we should use this high or this high, but anyways, let's map it into the future. So we're just using this low and this high here, and we map it into the future. After mapping it, we wait for price to come into our zone, right? Like that. Zoom in. Okay. So do we have an inside bar here? Yes, we do. Do we have a fake out? Though we don't. I don't see any fake out. What I do see is a mother candle, right? And I see an inside bar. So if I know that I'm in a bullish trend, I've already tapped into my point of interest, which is the 51 level and the 61% fib level. What I'm looking for now is to take longs. Usually, what I like to do is put my stop loss outside the range. But if you had seen this, I don't think somebody will want to buy here because there is really not much confirmation yet that we are pushing up here until maybe we got to this candle. So this price action here was not too clean, but the fact that the price taps into a point of interest, I think this should qualify this setup for a buy. And this is a bullish engulfing pattern. So this, in terms of an inside bar fake out, it doesn't really explain it. But in terms of what we've gone through before, this explains it. So this would be a good buy setup, and I'm sure it would actually map us good 1, 2, 3, 1, 2, 2 risk to reward area. So if you enter after this bullish candle closes, stop loss has to go always below the bullish candle. So this doesn't explain the fake out, but it's also one of the setups we've gone through. So I hope that was a clear example there. 1:2 played out, 1:3 also played out. Okay, so let's continue with this uptrend. Let's see if we're going to find an inside bar. So again, price is still bullish, right? So as long as we get a high and they start to retrace, we use our tools. From this low to this high, we drag it into the future. Right, price came here, mother candle. Take note, we also started to reject here, but we didn't really get a follow through. So if you enter on impulse, just because price is tapped into your zone, sometimes price will take you out. Right, so that's one thing you need to note. Mother bar, inside bar. Entering an impulsive move here would have been good. Here, there's also no fake outs. There's no fake out. Fake outs or the false inside bar, they are followed by a pin bar. I think if you just put that to your mind that, okay, if it's an inside bar, the fake out is most likely to be a pin bar because pin bar comes with a long tail, right? So if we had a pin bar here and they had faked out, let me just clear this. Let's say after this candle, then we had a candle with a tiny head like this and a fake out like this, right? Then that would qualify as the inside bar false breakout because they would have broken out to the other side of the mother bar. Whilst we know that we're bullish because we are in a bullish trend, price is being delivered to the upside, right? So we would have noticed that this would have qualified like what I'm saying. But however, this is still a valid setup because your price is reacting off the 50 and 61 level. Again, take note, sometimes price will come to this, what level is 78. This would be the worst case scenario, but the sweet spot is this area here. Sometimes price will just touch the 50. Sometimes they'll get into the 61. Sometimes they'll come slightly below. Sometimes they'll come in between the 50 and the 61. So these are all variations. Like I said, price is not perfect. So again, here there's no clean example of what we are explaining. Let's see here. Okay, the next impulsive move I have is this one. Okay, on this one, there's no example here. So I think this uptrend, where does it end? Or maybe we should go back to BDC because BDC had some nice examples for us yesterday. Oh, excuse me. Oh, okay, I've got no clean example here. Let's see as we are coming down from this particular price action. Do we have an inside bar coming down? No, I don't see any. I don't see any. Maybe let's look for another asset quickly. BDC USD. Okay, this is what we were explaining yesterday. Let's see here when we were coming down. So we're coming down. Here there is no retracement really. On this push down here, nothing too clean. So sometimes you won't really find clean retracements, especially if there's a lot of momentum in the market. Let's see on this part. Okay, I see an inside bar here. I don't see a fake out. Push up with momentum, no retracements. I've got nothing too clean here. Let's open a random pair, GBP SGD, 4 hour. I just want to look for one more example. Then I think we should be done with it. So let's zoom in here where we are pushing up. No pin bar here. So I'm starting from this low here, coming up. So if you run your fib from this low to this high, okay, the fib, if you run your fib from this low to this high, they do come to the 50, but there's no inside bar. All right. So again, this only shows you that inside bars, they don't really happen like every day. But when they do happen, then you have to execute the trade. So I've got no example here. We push up, nothing here. We continue, we push up, nothing here. We push up, nothing here, nothing here. Push up, nothing too solid here. Or maybe let me explain. I don't think it will be, but anyways, let me try to explain this view here. You see from this low to this top here, even though it's a ranging market, let's say you have seen it and you feel like price is still pushing up, right? So we want to look at all scenarios. Price retraces into our point of interest. Then we've got an inside bar here. You take your buy here and this candlestick takes you out. So this is just an example of what could happen. Maybe price could show you the right confluence that, okay, we are in a 50 to 61.8 fib retracement. You've got a mother bar, you've got an inside bar. Maybe with your session timing, you can execute the trade. If you're aggressive, you take your trade here, you're in buys, your stop loss is here. Then price just weaks to the bottom, even though this is really not a pin bar. If you're targeting these highs, price would have taken you out, then it continued to push up. So I want you to know that, like what the author said, it's not every setup which plays out. Again, that's why we use proper risk management. So I think that explanation should be enough for that particular example there. So let's go back to the book. Maybe we are about to finish it. I'm not sure on which page the book ends, but let's see. So trade examples. In this section, I'll show you different trade examples to help you understand how to trade the market using all strategies discussed in previous sections. See the first example below. Right. I think here the author is rounding up all the nitty-gritties or all the weapons we have, putting them in one bag and we're going to war, right? So we've got a downtrend, Euro NZD. It's moving. We can see this is a downtrend. So you can run your fib from this high to this low. Once you run your fib, you've got your point of interest. What's happening on your point of interest is you've got a pin bar, which is a sell signal. So this is a pin bar coming along. There's no inside bar on this particular one. What else do you see here, which is also a good confluence or a reason for us to sell? Price is also rejecting the moving average. You see the author has got a moving average there. So it's within the same range. We've got a fib. We've got a candle confirming. We've got a pin bar, and we are in a downtrend. So our reasons of selling are high. Execute a sell. Stop loss above the pin bar. Price melts to the downside. This level here is a support zone, right? Let's agree that it's a support zone. It's been broken. Price is retested. We also have a moving average on the same area, and we've got a bearish engulfing candle right there. This doesn't qualify as a pin bar because it's poking outside the mother candle, so it's not an inside bar. The next one is, even though it's a bit far away from the EMA, this one here. So if you've got your mother bar here and you know your direction, especially after getting a sell here and you get this is where you add your positions, you scale in, and you just maximize on that particular setup. So this is a good example which the author used in a trending market, right? As you see in the chart above, the market is trending down, right? You've got the trend as your friend. So as a price action trader, I will try to follow the trend and look for powerful signals at the most powerful key levels, right? So I like these words. The first signal we got is the pin bar. That was rejected from a support level that becomes a resistance, right? The second factor that supports our decision to sell the market is the rejection of the pin bar from the 50 fib retracement level. The third factor that encourages us to take the signal is the rejection of the pin bar on the 21 EMA, sorry, on the 21 MA. I'm used to saying EMA because I use exponential moving averages, but this one looks like it's set to, it's a simple moving average, which makes it an SMA, even though the author doesn't specify whether it's a SMA or an EMA, but it's a 21 MA. That was acting as a dynamic resistance. The second signal was an engulfing candle bar. As you can see in the chart, this candle pattern was formed at a resistance level in line with the direction of the market. This is how you can trade trending markets using our price action signals. It's simple. Just identify the trend and the key levels. It can be support or resistance level, a 21 MA, a 50 or 61% fib retracement. Wait for a pin bar, wait for an engulfing bar, an inside bar, or an inside bar false breakout to form near these levels in line with the direction of the market. Then execute your trade. It is not complicated. It is not complicated. So how many candles are we looking for? Pin bar. Backtest your charts, look for pin bars, look at where they happen. When they happen at a zone, check how the price plays out. That's how you backtest, right? In an engulfing bar, you've got a bullish engulfing and a bearish engulfing. Check how those candles react at points of interest. You've got an inside bar and you've got an inside bar false breakout. Check how these candles form near points of interest like support and resistance, supply and demand, or the 50 and 61% fib retracement. If these candles form at a point of interest, just execute your trade. Either you have a loss or you have a win, right? You just have to keep it simple. When you see a setup getting complicated, just leave it. Rather save your money and wait for the next best clear setup. Right. So here's another example below. Euro NZD is still the same pair, but this is now the daily chart. And as you can see, we are trading within a range. Do we agree that we've got two highs here? Maybe somebody might say, okay, how do I mark the highs? Do I mark the tip of the week? Do I mark the candlestick body? Guys, let me make this a bit simpler for you. Okay, I'll show you when we get to the charts. To make it easier, just try to mark from the week, top week, to the close of the candlestick bodies to make it a zone and not just a single price line. So once you make it a zone, it makes it a bit easier to trade on, right? That's if the market is arranging, by the way, or any zone you mark. Just make sure it's a zone and not just one line. Unless you know that, okay, your line is representing like a whole area, then it's easier. So as long as you've got your market structure right, everything should be pretty much simple and straightforward. So two highs here. I'm not sure if there's another low here, but we've got a resistance level, we've got a support level, so the market is ranging. What happens when we get to the resistance level? We are looking for either the price to bounce or to break and retest. Then this will become a support, right? Once it's broken and retested. At the top side, same thing. We're looking for either for a break and a retest, and this will become resistance. We're looking for a rejection and for the support level to hold. Those are the two things you need. So as price hits resistance, what do we have? We get an inside bar, a mother candle. Aggressive traders will buy just after the inside bar closes. There's nothing wrong with that. The only thing wrong is if the next candlestick is a pin bar and it decides to break out to the bottom side and still come back and close above. That will definitely take you out. But if your risk is calculated, you can still come back into the trade and look at the reward going back to the upside. You get it? So don't worry about saying, okay, how do I know whether the next candle is a pin bar or not? We don't know. Nobody knows. That's why we just have to execute what you know and what you see. So on this particular example, luckily there was no stop hunt. Aggressive entries here, conservative entries at the top here. We got a break, and good thing price also came to retest that break, and they continued all the way upright. So that's clear. At the top side, what do we get? We get a simple clean pin bar, executed the close, stop loss above. Either the price will take us out or the price will actually pay us. You get it? So that's how you simply have to approach the markets. As long as your risk is calculated, everything should be pretty much easy to do. As you see in the chart above, the market is trading horizontally between support and resistance level, right? We are ranging, we are in a range. This market is completely different from trending markets, and the strategy to trade it must be different as well. When the market is ranging, we do not use fibs. There is no fib retracement in a range because all the moves are pretty much equal. They're pretty much equal. There is no impulsive pullback, impulsive pullback, impulsive. When in a trend, that's where you use your fib. In a range, you don't use fibs. That's also one note you need to make if you haven't made that note already. In ranging markets, we trade from the boundaries. I mean, from the support and resistance levels. Don't ever try to trade inside the range, right? Don't ever try to trade inside the range. What the author is saying here is don't take your trades inside here, inside here, inside here, inside here. If you sell here thinking they'll come down, look at what they did, right? Or if you buy here thinking they're going to come up, depending with your risk here, they can still come take you out because there's no way you want to buy here and you target here and you stop losses here. The risk is not worth it. Just like we explained a few days ago or in the last video, or the video before that. In the chart above, we had two powerful signals. The first signal was a pin bar that was strongly rejected from the resistance level, and the second signal was an inside bar formed near the support level. See another chart below. Right here, we've got a nice moving average. I love how the author transitions from clean charts and also throws in a moving average here there, just to show you that everything in the markets works. A person who's trading naked charts can make money. A person who's trading using just trend lines or maybe moving averages only can make money. A person who's using indicators can make money. You just need to know your market structure. You need to know where your price is going, and you need to know what to look for. Those are the main things. So as a trader, personally, you have to see what works for you. You can start with indicators, then you can start trimming them off one by one as you understand how price is moving. So that's also one note I'm giving you guys, because you might be struggling. Should I use indicators? Should I not? So just figure out your personality, what works out best for you. All right. So in this example, again, price is in a downtrend. If you are using moving averages, a person once asked me, please elaborate moving averages or something like that. I'll just give you another note here. Here's the thing, no matter what moving average you're using, if price is trading below your moving average, it means it's a downtrend. If it was like this and the price is trading above, it means it's an uptrend. If you see your moving average like this and your price is moving like this, just know that in that particular market, it's either ranging or it's choppy, and you cannot use the moving average to formulate a setup. If the moving average is in between your price, it means either the market is choppy or it's ranging, and you cannot use the moving average for that particular market. So that's also another note to just jot down. All right, so we are in a downtrend. It's pretty clear, trading below the EMA, lower lows, lower highs. We're looking for entries. Where do you enter in a downtrend? There's something called fear of missing out. Sometimes you get on the charts and you find price may be here, or price may be here, or price may be here, and you want to sell and join in the trend. Such sells are not really advisable. Rather wait for price to pull back or retrace so that you can run your fib, then get a better point of interest. Run your fib, get a better point of interest. Run your fib, get a better point of interest. Run your fib, get a better point of interest. Or wait for price to retrace to your moving average, or wait for price to retrace to a broken zone, a broken zone, right? If the downtrend price is breaking zones and retesting, so always aim to enter your price at the best possible areas which offer you better reward compared to your risk. So in this particular example, we've got a nice pin bar rejecting a zone and a moving average. That's a trade. Another doji candlestick here. On the moving average, you can still execute a trade. Pin bar on the moving average on a broken zone, execute a trade. Another pin bar, and these pin bars are happening in line with the trend. So don't try to trade against the trend. That's also one thing I would advise, right? So as you can see in the chart above, there are three powerful pin bar signals. When the market approaches the 21 moving average, that acts as a resistance level. Sellers reject buyers, and from a pin bar, and form a pin bar that gives us a good entry point. All right. Money management strategies. I think that's a session on its own. So let's end today's session here. Let's see if I can jump in the charts one more time from page 160. I think this book is about to end. The importance of the stop loss. This is just notes, conclusion. Okay, so the next video will be doing a conclusion. Then you guys can tell me what book you want us to do next. So today's session ends here. We're just going to jump into the charts. Let's see if we can pick some nice examples. So I'm going to show you a quick example where the moving average doesn't work. For example, in this particular, okay, let me not use BTC. Let me use something like maybe GA. So you guys, when you're going through these videos, should also throw me some of the pairs you trade so that when I do examples, I do an example on something you trade. That will also help to boost your confidence as well. So in the comment section, just drop me what you trade. Then when we doing examples with charts like these, I can use examples on something which you actually trade. So I'm going to jump to, I'm not sure if I should use H4 or H1 because H4 on my charts comes with this Gatli, it's got a Gatli indicator, right? So it might confuse people. Okay, anyways, here's a clean example. Do you see here where price was creating these equal highs? Do you also notice that the moving averages are within that price? They are within the price. So these moving averages, they don't work here. You don't use them when the price is all over the place and the EMA is within. You don't use your EMAs. Rather, you wait for either a pin bar, you wait for either a bearish engulfing, or you wait for an inside bar. Those are the only candles you're looking for from the top side and from the bottom side as well. So on this particular example, let me use H1 so that there's less colors on the chart. Then I'm also going to jump into a naked chart as well. Okay, so again, this is a clean example of a downtrend. We're trading below the 13 all the way, right? And we eventually come below the 50 as well. So once you figure out your trend, you're now looking for candles, pin bars. You're looking for inside bars. You're looking for dojis, inside bar, dojis, inside bar, inside bar. As long as you're in a trend, you know what to look for. So if you're day trading, there is a trade on this day, there's a trade on this day, there's a trade on this day, there's a trade on this day. This is 4 days of trading, and you've got a trade to take each day, just trading one pair. Sometimes you might go a week without a trade because the price might be choppy or the price won't be giving you anything clear. There's nothing wrong with that. Everything is pretty much simple. Sometimes you might get a trend like this. You've got this high, a lower low, lower high, equal low, lower high, lower low. If you run a fib from this to this, the 51 level, let me see if I can run a fib here. The 51 level, there's nothing, or you don't get a follow through setup. That's what I'm trying to explain here. Where's my, okay, there's the fib. So which high can we use? We use this high to this high. So pardon my fib on this particular platform. It's just crazy like this. All right, so price comes into a point of interest. This is the 50. And this is the 61. So when we got here, we got our nice pin bar. We could have sold. Again, if the risk to reward is worth it, you take it, right? Okay, I don't think this is the example I wanted to explain. But anyways, coming from this high, price rejected with a pin bar. So you could have taken a nice sell here. My next point, which I want to explain, is from this high to this low. Yeah, that's what I wanted to explain. So when price comes into the 50 level and 61 level, this is right here. Right? I want you to notice how we get an inside bar, but we do not get any follow through to the downside, even though we were in a downtrend, right? These are things which happen with the market. They are normal. Sometimes you take a trade and it will not play out, right? So that's why we use stop loss. That's why we calculate our risk. So also take note, like what the author said, some trades will play out, some won't. Sometimes you might see the pattern, but it just won't play out. So that's why the author emphasizes use of a stop loss, and that's why I also emphasize it as well. Let me see if I can this. Okay, I cannot remove it. Anyways, I'll remove it later. So that's another example there. Going back to the naked chart, staying with the GBP SGD. Naked charts, I love them because I can line up my fib clearly without anything hindering my view or my anticipation. Okay, so here we are trading up. We've got a zone. This is a huge impulsive move to the top side. If you line up your fib, looking for a continuation, price gets into the zone. We get a nice inside bar here. This tried to fake us out depending with where your stop was. So if your stop was outside the mother candle, your trade is safe. But if your stop is right below the zone, that's the pin bar which takes you out, right? But remember, like what the author said, you have to anticipate fake outs because we don't know what the market will give on the next candle. We don't know what the market will give within the next few hours. So if price takes you out, but they still show you that it's a fake out, then what do? You simply have to jump in back into the trade, recover your loss, and call it a day. Unless price continues to come down, then your trade will be violated. So this is another example of a good buy signal there. Stop loss outside the mother candle. The reward going back to the high. Is the rest to reward worth it? Yes, it's 1:3.86. It's almost 1:4. So it's worth it, and the trade needs to be executed. How do you know that the trade is worth it? As long as the risk to reward is more than 1:2, you can execute on that trade. So let's see here, coming all the way down here, right from this high. Let's see where we can get a setup. Nothing too clean here. Fib from this high to this low. When price got into our point of interest, what did we get? We got a pin bar, sell at the close, stop loss above the pin bar, 1:2, 1:3. Yes, take the trade. So these are just some of the things you need to look for. And just remember that the higher the time frame, the higher the reward. The higher the time frame, the higher the probability of the setup playing out. Some price action, price will just accelerate without giving retracement. Some retracements are shorter in such a way that price doesn't get into the 51, into the 50 or the 61 fib retracement. That's how the market moves, and there's nothing we can do about it. So if you don't get a setup, you don't have to stress. You don't have to, just make sure you don't trade. If there's nothing you understand on your particular charts, do not take the trade, right? Another example here, we're now pushing up aggressively. We've got a demand zone here. We've got the 50 and 61 here. We've got a nice pin bar here, and we also have a bullish engulfing here. Is the reward worth it? Taking the trade, coming back to this zone up here? Yes, it is worth it because I'm sure it's 1:2 or more. So I hope these sessions help, guys. Sometimes my explanations are not too clear. So where it's not clear, please bear with me. I'll just be explaining according to my own understanding. But also where it's not clear, feel free to just hit me up with a question, either on Telegram, WhatsApp, or on the comment section. Just write a question. Then I can still do a separate video just doing a quick explanation, whatever you need understanding, especially if I know how to explain it. On whatever I don't know, I'll try to tell you that, okay, this is out of my knowledge capacity, but whatever I understand and know, always willing to share that knowledge. So I hope today's session was helpful, guys. The next session, I think we're rounding up the book, and it should be dropping tomorrow, which is a Monday. Then after it drops, I'll remind you guys to just drop me. If you've got a book you want us to go through, then we can always do that. So I hope today's session was understandable and clear, and you guys took some notes. When we resume, we're starting from page 162 to the end, if I'm not mistaken. So thank you so much, guys, for your time. Thank you for watching. And don't forget to subscribe, guys. If you find something of value in these videos, subscribe, share this video with a friend, hit a like, drop some comments. Let's interact. Let's make this exciting. So thank you so much, guys, for your time. If you watched till the end, thank you so much, and I wish you well in your trading journey. Good trading.